me introduce our speakers, Alex and Colleen. So Alex is a senior farm management consultant with MNP's Prairie Consulting Team. He's out of Winnipeg, Manitoba. He works one-on-one with farmers and agribusinesses, and his strong problem-solving skills allowed him to find innovative solutions for his clients. He's focused on strategic and financial planning all around making the best for his customers. Colleen Tate, she's on the province to the other side of me. She's a business advisor with MNP's Assurance and Accounting Team in Edmonton, Alberta, and she leads the firm's national poultry and Alberta's food and beverage processing teams. We have got great presenters with us with a host of experience that they're going to speak to in the next hour. I don't want to take any more of your time. I want us to dig right into it. So, Alex, Colleen, let's get rolling.
Thank you, Lane. Thanks for having us again here on the webinar series. We're excited to get going. Okay, so I may as well dive right into it and do a quick overview on what we had talked about in our previous webinar, just to help it segue into the one we're talking about today. So a lot of what we've talked about so far, and what we cover quite a bit in the in-person sessions we have been holding, is a SWOT analysis. So what is that? For those of you who don't know, a SWOT analysis is essentially an analysis that gives people, regardless of the industry that you're in, the ability to recognize all the relevant details that might affect your operation. So it helps you find opportunities for growth and development, but also helps you gain a holistic understanding of the environment your operation is in. So in a SWOT analysis, you divide, you can take a piece of paper. For those of you who tuned in last time, I heard a couple of people actually completed one and brought it in. So that's awesome. So you take your piece of paper, divide it into 4, and identify some of your strengths, your weaknesses, your opportunities, and your threats. So for more detailed information about a SWOT analysis, you can watch our previously recorded webinar that's available on the FCC website. So I won't spend much more time on outlining a SWOT, but you can see up on the screen here, each of the buckets kind of outlines what areas of thinking we're really trying to narrow in on when we do these types of analysis. So just to quickly brush over strengths, what do we do well? Weaknesses, what are things we need to improve on? What are maybe some weak points in our business? Opportunities. So these are a pretty easy word to understand. What is out there for you as an opportunity? Are there trends? Can we turn some of our strengths into opportunities? That's kind of what we're looking for in that piece of the SWOT analysis. On the threat side, well, this is kind of the area we're likely going to be looking towards mostly today, is the threats. What can harm you or your business? What are things that your competition are doing that maybe can pose a threat to your operation? And what do your weaknesses really expose you to in terms of a threat in the operation? So getting in this mindset is a good start to our session here of what we're going to be looking at. So we're going to start it off nice and early with a poll question to get everybody awake and make sure that we can get the platform rolling on your end. So we're going to look at the relevance of a SWOT analysis. And I would ask those of you who are able to poll here, which section of the SWOT analysis are most important for risk identification and evaluation in your opinion? So take a minute, go ahead and answer your questions here on the poll, and we will take a look at what comes through. Okay, so as we see the results of the poll come through, what we're really looking for is the most important for our risk identification really falls into the the threats and weaknesses area here. We're looking at a lot of what factors can really pose us a huge risk. So when we're talking risk, we're talking threats, we're talking what type of exposure we have. So weaknesses can kind of create a weak point, so to say, but definitely threats. So it looks like we had a lot of answers towards threats, and that is absolutely correct. So well done, everyone. It looks like we're underway for a good session already. Okay, so just to kind of elaborate on that, the reason why I wanted to briefly reintroduce that SWOT analysis is because it really is central to risk identification and evaluation. So to be more specific, the weaknesses and threats portions really allow us to identify our risks to our operation and prepare a contingency plan. So if you haven't done a SWOT analysis before, I would highly recommend it. Although it can take as long as 5 minutes up to a couple hours. It depends really what you put into it is what you get out of it. So if you're looking for a bit more information on SWOT analysis, there's a resource section of the webinar platform. You can download a helpful worksheet on SWOT analysis as well if you've never conducted one either. So just to elaborate a bit more on weaknesses, as I mentioned before, these are things that you reflect inwards and say, okay, what are things I could improve on? Do I maybe have some shortages of resources that maybe some of my peers do not have, or people like my operation that they do not have? And what are some weaknesses that others might see in me? So if my neighbors know maybe, I might be the most agronomically sound person, but maybe I'm just not as good on the bookkeeping side, what have you. It doesn't make a difference what your weaknesses are. Those things can open you up to different risks as well. On the threat side, this is really thinking now on an outwards type lens versus looking inwards or internally. So what threats could harm you in your operation? Things that your competition is doing that maybe is different than yours, that could maybe pose a threat to your well-being, to your competitiveness in your market. And then again, what do those weaknesses expose you to? So if you're not a very good bookkeeper, perhaps you fall behind on your bookkeeping quite often. The accountant jumps up and down, and then the bank starts jumping up and down trying to get your financial statements in. These are small little examples that kind of trickle through weaknesses into threats. So overall, these are kind of what we're going to be focusing on today. Okay, so when we start looking at identifying risks, I just want to go through a couple of best practices in terms of where to start, how we really need to get into the right mindset to start thinking this way. So when we're talking best practices here, the first thing I would say really is we need to have big picture thinking. So when I say that, I mean that we really need to think outside of just our day-to-day and small things. We have to start thinking a bit more abstract. So when we start asking ourselves, what if, this creates the possibility thinking, which leads to innovation. So if there are things that we think of, okay, well, if this happened, I'd really be in a pickle, right? That's the start of understanding what risks that we're maybe privy to. But this also helps us identify things that maybe are out of our control that we want to prepare for. Maybe it helps us hone in on areas that we need to be paying closer attention to. In terms of risks, it's so easy just to say price and to say, yeah, price risk. We're in the agriculture business. Price risk, that's everything, right? But okay, let's go one layer deeper on that. What drives price in your industry? Is it, are you relying on more world market information? Is it more locally driven? What do you really need to be paying attention to? So this is kind of the type of thinking that when I say big picture thinking, it's almost like peeling the layer back of the onion to really get a layer deeper and say, okay, well, if I say go to the easy route and say price risk, those are the types of next questions you need to reflect and ask yourself. when you're looking at identifying risks. Okay, and the next piece, I would say a best practice is thinking critically. So contingency planning is really only even relevant or useful if we're willing to take a look at our situation from a different lens. Things could be going really well right now, and it's maybe not as fun, or maybe you don't even want to take the time to think of, okay, what could be happening, what could happen. And this type of thinking can be really uncomfortable for some people. I'm no different. I don't like necessarily plan for, okay, well, if I get stuck on the side of the highway in a snowstorm, what can I do? Right? So that's no fun to think about, but it's easy to have a little jump kit in the back of the car, thinking critically about it. Okay, maybe you have a shovel to get scooped out. Just little things like that, just to think of kind of the worst case scenario and how you need to handle it. So to go a different route on thinking critically, this is where really the best part about looking at your weaknesses when you're thinking a little bit deeper here is, do they open the door to certain risks? So I used the bookkeeping example a minute ago, but I would say when we talked about weaknesses in the webinar prior to this one, we talked about a lot of people in agriculture, they do have a weakness of having trouble delegating tasks on the farm. So a lot of people say, oh, I can do it better. I trust myself. I don't want to have anybody else do, task X. I want to do it. Well, really, if you have a lack of delegation skills, it can really lead to you being overworked, maybe being fatigued, underutilizing your workers. Maybe it causes, uneven, inconsistent expectations of those who are working on the farm. So that can be family, it could be staff, it could leave them a little bit unhappy if you're not willing to share in some of that work. You're just kind of saying, no, stand aside, this is my thing to do. So this opens the door to dropping the ball somewhere else. It's hard to keep all those plates spinning at once if you're kind of a I can do it all type person. So really that is something to consider as an example here. Okay, so some important questions that I like to kind of bring up to have you think about when we're talking risk identification and best practices. So pardon me for kind of reading the slide here, but I'll go in deeper on each bullet here. But what are your primary competitors' strengths and weaknesses compared to yours? So, okay, so agronomically, it's okay if your neighbor grows, a better crop than you do. That might not really affect how your business operates. If they have an extra 2 bushels, all that really gets them is bragging rights at the coffee shop. But if they're a really strong relationship builder and maybe they get better deals on the last piece of equipment or a piece of land that goes up for sale, that could be a risk to your operation in the sense that you might be second in line for almost everything if your neighbor seems to be better at those different types of skills. And then next would be, what are your biggest risks and how do you identify them? I don't want to spoil this one. This one we go to in a little bit more depth a little bit later on, but it is really important to understand the severity of the risks that you identify and basically being able to understand, okay, if this can happen, what's our plan? What can we do to hopefully avoid this at the highest rate of success? But the question really is, how do you identify those risks? And that goes back to really thinking big picture and honestly chatting with the stakeholders in your operation, whether that be family members, workers. It really depends on your operation, but hearing from everyone might actually bring to light some different points of view and different opinions on kind of what's going on with the operation. So what tools are in place to manage these risks? Again, I'm going to get into that a little bit later, but there are definitely tools in place for different types of risks that can occur on your operation. What's your contingency plan for death, disability, divorce, a disagreement, departure? So these are things that we see a lot of in our line of work with planning and different operations going on. These are kind of unforeseen circumstances that can really throw a wrench in your operations plan. So keep that in mind. Are there any risks that could impact your cash flow? So these are ones that, a question that you really need to understand. Okay, risk is risk. right? Oh, this would be really unfortunate if, one of my workers left. But how does that impact my cash flow? And then last one here, what's your contingency plan if you can't meet your financial targets? So this is something that you can work a little bit closer with your banker, your FCC rep, basically what you're willing to do or what the plan is if things kind of go south on you. All right, so that takes us into our second poll that says, what contingency plans do you currently have in place for your operations? So you can select all that apply. We have death, disability, divorce, disagreements, and departures. So take a minute and we'll see how it comes back. Okay, so it looks like our number one answer is death with followed by departure. So yeah, they can be very unexpected things that can throw a pretty big wrinkle in your operations day to day. So obviously the loss of a family member or whether they be working on the farm or not can definitely throw a change in the operational aspect of the farm. So this is something that although it can be uncomfortable to plan for somebody's death or someone's departure, it is something that we have to say, okay, well, maybe it's smart to understand what everyone's role is on the operation. So if we're talking about, okay, if maybe someone who operates all the machinery or feeds the cattle every morning, what do they do in a day, and how could someone pick up the slack if they were all of a sudden unable to work for any reason? So these are just little things that, well, they're big things, but the planning for them can just be as simple as understanding what they do and how we can divvy up those tasks in a pinch. All right, so that takes us into our next steps category. Get one more slide over. So really, when we're evaluating risks, and now that we're at the point where we've identified some risks in our operation, what do we do next? So we need to be able to prioritize these risks that we've identified, as that's really the most important aspect of being able to address all the risks that could happen on your operation in a timely manner. So why do we do this? Right? You're saying, Alex, risk is risk. We'll figure it out. Well, I disagree. Right? Not all risks pose the same threats. That sounds a little abstract, but they don't. Right? If someone calls in sick one day is easy to cover off. If a field's on fire, that's a little bit different. So some are a little bit different than others. So when we go into the first bucket here, this is where we think about risks that would require our immediate action. So this doesn't necessarily mean risks that aren't far out in the future, but which ones would really require immediate action and attention. So think about things tangible actions that you would have to take. So kind of back to our poll, we're looking at if someone has a medical emergency, if there's a fire in the shop or a fire in the field, maybe even if the banks call your loan. These are all things that we really do need to have an immediate action plan or contingency plan if something like this were to arise. And so this is something where you have to have on your list of things to say, okay, if one of these acute instances happen, what do we need to do? So that takes us on now to kind of a different level of risk or a different type of risk where these ones, maybe you have to just mitigate them the best you can. So which risks do you have that you can mitigate? So are you prepared to take a hit? And what does that look like? So these are risks that we anticipate can have an effect on us, but we have limited control over. So if we really are thinking here, we're talking, say market risk. I know we talked about price risk before, but when we take that layer deeper, we start to look at, okay, well, what if, for those of you who are canola growers on the call, what if China stops buying canola again? What if we get into geopolitical issues again with India regarding pea imports, right? These are all things that are kind of out of our, well, they are out of our control unless you're buddies with one of those governing bodies. And so really what we need to do is, okay, what is our plan? Not necessarily to react to these types of instances that cause us a threat on our operation, but really how can I mitigate this risk? So if we're worried about willingness to purchase a crop that I'm growing, we can look at a crop rotation that helps kind of mediate some risk. We can look at maybe selling some incrementally, maybe not selling some at all. Everyone has a little bit of a different opinion on that. One that would have hit home in the last, I guess, couple of years, maybe not this year in particular, but fertilizer availability. If you're worried about your fertilizer availability, this is something where you might have to pay up a little bit when you don't want to, but knowing that you have some is worth people's peace of mind. So you can mitigate some risk by maybe pre-buying a little bit, have some on farm if you are able, just little things like that. So you can no doubt plan ahead to mitigate your risk, but this is something that we just need to think about in advance to help kind of just take care of it a little bit at a time and not necessarily be reactive, but more of a proactive approach. All right, and then that takes us kind of to which risks are in our control. So this is really, in my opinion, where we start to look at the weaknesses part of our SWOT analysis and say, okay, well, the result of some of my weaknesses, what can I do about that to help eliminate those risks or really manage the level of that risk? So this is something where you really have to have a tangible action, a proactive action, because really if you say, let's just say safety risk on the farm. We run long hours, we have minimal staff, and we like to work in the dark, let's just say. A safety risk, this is very much in our control. Sure, the unexpected can occur, but if we're having our workers on 16-hour shifts and combining into 3 a.m, in my opinion, that's a risk that we can control. We can separate out breaks so then people are a bit more fresh. But to take kind of a sidebar to this, a different, maybe less tangible risk, actually a disagreement on the farm, right? So this is a risk where especially if family is involved, things can get a little bit tricky with some. So how can we mitigate that risk in advance? Well, it's not uncommon to see partnership agreements between family members or business partners. So this can really help protect yourselves from each other. And really, it can help steer the operation down its path that you want it to go. So if there are disagreements, there can be kind of measures in place to allow for decision making on the big ticket items or decisions on operational changes. So some partnership agreements have stuff in there where you need to have a vote on purchases of equipment over a certain amount of dollars or what have you. So these just help mitigate any kind of pressure point or tension that could occur in the partnership that maybe didn't happen before or that has happened in the past. So this is just an example of something that is very much in your control that you can be proactive about. All right, so let's go through a couple of examples of the types of risks that we see. Oops, went too far. Okay, so in my experience, we've identified some risks, but there are 3 common types of risk that kind of blanket over every type of operation, whether it be agricultural or not. So let's take a look at these 3 types of risks. So I really focus on, we talked about price already, that's kind of the easy one to identify. For lots of you, there's production risk. So that's kind of goes without an explanation. And there's debt risk as well. So it is important that each of these types of risks can be used as a tool, right? You guys are in agriculture. You guys are in the business of risk. So all of these buckets of risk offer a kind of a level of mitigation in their own different way. So when we think about risk and mitigating risk, it's not an all or nothing decision, but it's really more of a slider and on a balancing act. So that's why I chose to have kind of these sliders, because this is how I feel it hits home to people a bit better. When we're making a decision on mitigating something, it doesn't always go one way all the way or one way the other way. So often you're trading actually one type of risk for another when you're making these types of decisions. So let's go a bit deeper into that and kind of see what I'm talking about. So let's start with price risk. This one's the obvious one. Market goes up, we're happy. Market goes down, we're not, for the most part, unless maybe you're on the wrong end of a hedging deal. But what decisions can be made that decrease our price risk? Well, sell something, right? Once it's sold, money's in your jeans, it's there. So that's, sell something, whether it be today, in the future, lock in that price, then your price risk is gone. You could enter into a production contract. So some production contracts, they have a price, a guaranteed price, or for some, a guaranteed basis built in, premium, what have you. So that can help mitigate your production risk, or sorry, your price risk. And then there's also margin-based insurance out there, many of you would be familiar with. So this protects, basically, it's not based on what you produce, it's based on how many dollars you produce. And they have their algorithms of determining each operation's value and level. But essentially, this is one way that you can mitigate worrying about price much. That takes us over into our production risk. So kind of the opposite of price risk in a lot of our examples. What are some decisions that can be made that decrease production risk? Well, the kind of the obvious one is wait, do absolutely nothing, right? A lot of producers, they like to see the crop hit the bin before they even sell a bushel of it. And others, they like to not do that. Sometimes they sell incrementally forward sales. So again, this is not always a all or nothing decision. If some people only like to sell, 20% by June 30th, and then the next 20% by August 30th, and then the rest off the combine. All the power to you, right? So that's why I like the slider, because often when let's just say you locked in some canola, so that takes away some of your price risk. So it moves the slider one way. But now you've taken on a little bit more risk on the production side, because if you come up with a weak crop, now you're on the hook for that production to somebody else. So those two sliders kind of go backwards and back and forth with each other, kind of teetering the balance a little bit. So those are two things that really are a balancing act. And the obvious one again here is production insurance. So a little bit different than the margin-based insurance, in that this is based on your production level, not on how much money the crop is worth. So I know in Manitoba, the way we have ours is, if you produce a monster crop, but the price went way down, you're out of luck. Whereas we've seen it in previous years where the crop wasn't very good, but the insured value of that crop was a lot higher than market. So actually those who were in a claim position still had relatively strong years. So this is a different type of insurance from our margin type insurance. So it's just another option to mitigate that production risk, while also making sure that you protect the money that goes into your jeans. And that takes us now to debt risk. So we need to understand how debt and how leveraged our business is. So during good times, during bad times, what does debt do on our operation? So it can be a really, really good tool if used properly and responsibly. So debt-free farms, they're a lot less likely to have, they're likely to have more tolerance for risk. A little tongue twister there. So if they have less debt, they can take on more risk. They can take kind of a one to the chin once in a while. They can ask for money from the bank a bit easier because they're less leveraged. But a highly leveraged farm, they face consequences sooner and more harshly from setbacks. So if we have a really bad year in cattle and we're all in, we are all in, and prices go down. Well, if I don't have any debt payments or very small debt payments, the bank is kept happy. I made my payments. Whereas if I just bought a new farm, I'm fresh into the market. I'm day 5 of being a farmer, and I'm highly leveraged. Well, if prices take a big downturn, the math that I did to get approved for my loans now isn't quite working out, and things might get a little bit tough. So the more leveraged you are, the quicker you see these consequences show up. That doesn't mean that that's bad, right? It also provides opportunity to grow, where you can grow using the bank's money a little bit. So if I'm properly leveraged, I can definitely be a successful producer using somebody else's money. So that's something definitely to consider. Another example of risk, and I always go back to this example because it's something that's very real. Rented land that comes for sale can always be a risk. And the reason I say that, it's not just because neighbors might grab it. Might not just be because, might lose the acre. It's tricky because if I have 4,000 acres total and I rent half of it, and my debt load is just right, I'm doing well, but if now that rented land comes up for sale, I have to consider, okay, well, if I have to go out and buy that land, now my leverage, I'm highly leveraged compared to before, but my productive assets never changed. I'm still farming the same amount of acres. I'm still getting off the same amount of crop, yet my debt payments just went up by 70% from what they were before. So that can be a tricky situation for someone to be in who are maybe not in the perfect position to acquire that land. So really, that is something to consider as well. And then competition, that's always a risk. You might not get those acres back if you end up losing those acres. So if you're outfitted for your 4,000 acres and you lose half your acres to someone else, now you have all this equipment, all the resources, maybe the labor force to excuse me, to support a farm of that size. So some key kind of ideas here is really manage those relationships that you have with those who are renting to you, because you really want to have that option, right? And if they don't have the right of first refusal on your rental agreement, that might be a good idea to put in there or to ask about, because it really is good to have that first right of refusal, to say, hey, it's coming up, I want to give it to you, give you the option first. So it's really important to just understand your position in all that. So keep that in mind when you're doing that with a rent agreement. So kind of to summarize what I've talked about in terms of risk, each decision will really move the needle one way or the other. Slide the slider across one way or the other, which might counteract a different type of risk. So when considering that, you have to think, okay, can I self-insure if disaster strikes? How does that affect my decision making on my tolerance for price risk? If I've got lots of money in the bank, I've got no debt, I'm willing to wait out a bit of a downturn in the market. But for someone who maybe has minimal storage on the farm, somebody who is highly leveraged, maybe they're less able to self-insure. So maybe they need to take different actions into covering off that risk a different way. So when we start looking at it in that sense, we have to really understand what those decisions can be. So do I pre-book feed? Do I ride the cash market? Do I price my grain in the field before it's ready to get combined? Or do I want to have unpriced grain in the bin? It doesn't have to be all or nothing. I really want to reiterate that risk isn't a bad thing. It's just understanding personally what you're able to handle in the different areas and that they occur. So each manager has a different comfort level for each type. I work with a lot of clients who they swear off debt altogether. They say, no, the ultimate goal is to pay down debt. And that's okay. That's one way to look at it. And others, they really want to focus on growing, and they're comfortable using debt. I've worked with a handful, more than a handful, a wide spectrum of producers who refuse to price anything before they have it. So that's just one way to help them sleep at night, and they're willing to trade off maybe some price opportunity for that as well. So it's all about trading back and forth between each type of risk and essentially understanding what the ramifications are on each of your decisions that you make, both on your personal well-being and in the well-being of the operation as well. Okay, so this takes us to our third goal, which we call the balancing act. So let's reflect on your comfort level with all of our types of risk here. So which of these three would you say you're the most uncomfortable with? Which one gives you a little bit of makes you not sleep very well at night? I'll let the rest of these answers come through and we'll take a look at the results. Okay, so it looks like just about half of you, the one you're most uncomfortable with is the debt risk. And then right next to that is price. So it sounds like this group is very confident in their abilities to be good producers. And that makes me very happy. So the stuff that we can control, I mean, that makes that sense, right? Like we do our best to put the best crop in, or feed the animals the best we can. But really the price is a bit of an uncertainty. Production can be, but we feel we have a bit more control over the say of that. But then debt usually does take precedent over those two. So for many, you have a high balance on your operating line. That's a little bit different than, say, termed out debt. Those kind of are a little bit different beasts in my opinion, but those are very valid discomforts to have. All right, so now we're going to talk about some tools and resources that we have. So what are some things out there that we have available to us? So first and foremost, we have agri-stability, right? We have a lot of government funded programs, and that is kind of the pillar of many agricultural operations across the country. So it's more of an emergency insurance. It's not meant to be a top up like maybe some of the other insurance programs are. I don't need to tell most of you that. Most of you are quite fluent in agri-stability. So the next one would be risk management program. So that's, we got livestock across the country. There's different programs as well that help supplement different nuances in the market. I know we had a couple of years ago when there was a hay shortage, they implemented some funding for bringing in straw and feed for animals province to province to help offset that cost. So these are things that we can enroll in, pay into a little bit, and make sure that we have that coverage. And naturally, crop insurance, not everyone is in crop insurance, but it is an option where you can protect your production, you can protect your your margin, and these are things that in the right mix of one another that they can really help you sleep at night. And this is a lot of stuff that we do. We have a tool here at MNP that we take people through every growing season to kind of weigh the different options with the insurance coverages and see kind of what the sweet spot is for those who are looking to enroll. So production contracts, I covered that a little bit earlier, but essentially in my grain buying days, some producers love these production contracts that had guaranteed movement at guaranteed time windows, sometimes at guaranteed prices, and a lot of the time, not all the time, can't speak for every grain company across the country here, but sometimes they have a act of God clause in there where if your entire specialty crop gets wiped out, you're not on the hook for those committed bushels per se. So that's one way that you can use this tool as well. Forward sales, pretty simple one, right? We can really pick off some of our risk on our own by pretty much just picking away at our price risk while managing our tolerance for production risk. So that's kind of I would say these are the most generic tools in our toolbox that I think everyone has access to. Okay, so I'm going to get into a Q&A here, but I will start with, we kind of have an FAQ. So just, I'm sure many of you have the next couple of questions kind of already picked out in your head. So the first one being, well, I guess I should say, first of all, if you have questions, type them in the chat at any time. I'll go through the couple of FAQs that we typically see here, and then I'll have one of my co-facilitators feed me a couple of questions that come through, and I'll do the best I can to get you a good answer. So the first one I wanted to cover was just the general like risks. Like, what do I do? How am I supposed to know what to do? Or I don't know where to even start. So again, I would say that every operation and every operator has such a different tolerance for risk at different times, in different buckets. And I'd say the biggest, most important thing is really figuring out for yourself what areas you're comfortable in and which ones you are absolutely not. And it doesn't have to be that extreme either. I've worked with many producers who didn't realize they worried so much about production. They were very much like the group here. They said, nope, price and debt are terrifying. When really, when we were working through some of their options for forward contracting, for understanding different options for them in the market, they told me when we put a strategy on, it was a different type of tool, but essentially if the market went up, they were able to participate. He told me that, it was a successful strategy, that he did make some money on that move, but he told me, Alex, I want out. We made a bit of money, but I did not sleep last night thinking about what could happen this morning. So I found that a very interesting exercise for him, because he said, yeah, I'm in. I like that idea. I think I get to participate. I get to learn a bit about some of the things that are available to me in the market. But then after the fact, even though it was a successful strategy, he made money. He said, I did not like that one bit. I was terrified. And then we never did one again. But it was a learning opportunity for both me and him to say, okay, well, now I understand that my tolerance for price risk is a lot lower than I had expected. And so it's important to reflect on yourself and to say, okay, well, where's my comfort zone, right? Some people are super uncomfortable with production risk. I've said this before, where they refuse to sell anything unless it's in the bin. That's a sound strategy if that's what helps you sleep at night, knowing, hey, I have to focus on my production, and then we shift to focusing on our sales. Sure, you might trade off some control on price risk or price managing your kind of marketing strategy, but again, it's about moving that slider to where it kind of comes into balance. And for some, that's with one over here and one way over there. For other people, they're kind of right in the middle. They dabble in a little bit of everything, and that helps them feel like they're being proactive, helps them feel like they're on top of things, but also adds a little bit of that, tingle in their fingers of saying, okay, like, let's hope something good happens. So sometimes you do just need to live with the risk. Like I said, you guys are in the risk business. You make money as a farmer on risk. It's a fact, right? You have to be able to tolerate some level of risk in some capacity, like it or not. So if you wouldn't put the crop in the ground and cross your fingers every year if you didn't like risk a little bit. Doesn't mean you're going to be on the pro poker tour next year. It just means that there is something of an aspect of your industry that does really rely on you relying on risk. Our second one, this one we get a lot whenever we do presentations or do something like this. What's the best way to address, our cost inflation? So I would say it's hard to mitigate that risk truly, because a lot of these things we don't necessarily have control over the cost of inputs. We don't necessarily have that, right? So what we can do, I'd say my biggest takeaway from my recent years here is be proactive in what you think your needs are going to be. So if you think that, okay, things are looking a lot more expensive than say last year, man, I've already prepaid, or I've already bought my crop inputs from the elevator and my line of credit there is already tapped out. What do I do? what we tell our clients quite often is if you're in a position where you think you're going to need to lean on your operating line a little bit heavier than maybe previous year or ever, you need to let your your banker know. So if it's, whoever you're with, you need to let them know if you need a bump in that operating line, because even if you don't use it, it's easier for them to help you out when you're not already, your back isn't already against the wall. We've had some producers who would go to their bank, ask for a bump in their line of credit when it was already maxed out. If anyone knows anything about, say banks don't always love to be called up and, demanded of what they are needed. They'd rather work collaboratively with you. So you say, hey, listen, I think looking at fertilizer and feed prices, I think I'm going to need a bit more room this year to put in the crop or to feed the animals around this time of year. Is there a way I could have a bump until next year of 15% on my line, just so that I have that wiggle room to know that I have it? More often than not, they're willing to help, even help you with a plan to understand kind of when your cash flow comes in and what you can do. So just including the professionals you already have included in your operation is really imperative to managing this type of risk. I know it sounds like we didn't really talk about costs or inflation really in that answer, but the fact of the matter is that it's out of our control to fix it, but it's definitely well within our control to come up with a game plan to help us weather that storm a little bit better day by day. So really, risks are really, in my opinion, a very much internally driven behavior. So if you've identified a risk on your operation, it's up to you to figure it out. It's a very dangerous game to say, oh, well, that will never happen. But what if it does? What if it does happen? And what are the things that you're going to do? And just because you have a plan, that doesn't necessarily mean that it's going to be okay. That sounds terrifying, but how can you best set yourself up to either weather the storm, avoid that risk altogether, or realistically, we're most concerned about your operation staying viable. So we talked about in our poll where, oh man, like if someone were to pass away unexpectedly on the farm, that would really, really mess things up. Okay, so that's a big risk of ours. We need to understand what it is we need to do if that happens, not just hoping the day never comes. So can be uncomfortable for many, and it is an uncomfortable topic, and risk is for many very uncomfortable. But it's something that you can't just look the other way until it happens, because that's when things really start to snowball. When something unexpected happens, you don't know what to do. Now you start dropping the ball on other things, other risks and threats start really piling up, and who knows, maybe you miss a payment, maybe something gets delayed, animals don't get fed till too late, or crop gets standing and there's supposed to be a whole bunch of rain in the forecast and you won't be able to get it back out there for another week. These are all things that one thing does always typically lead to another, where if you drop the ball, it's really hard to get back caught up. So if we're going to be in a tough spot, I'd rather have a game plan to dodge a few punches and throw a couple of my own. I guess, let's take a look. Is there any questions in the chat? We have a few more minutes to cover off here.
We do have some questions, Alex and Colleen, and let's jump into them. So the first one is, how does waiting decrease your production risk?
Okay, so what I mean by waiting would mean production risk. What I call production risk would be if I don't produce it, but I have no obligation to sell it to anyone. That is the production risk I'm talking about. So it sounds like price risk, but if I committed 20 bushels an acre of whatever crop before I combine it and I end up with zero, now I'm on the hook for that 20 bushels of, say it was wheat. I'm on the hook. I owe someone that wheat. And if I can't provide that wheat, now I'm at a tricky spot where I either owe them money to cancel. It gets to be a whole mess. Whereas if you don't have any commitments, sitting tight, waiting to see what comes off the field, then you know what you're working with. So sorry if that wasn't clear on kind of what I meant by production risk and waiting, but waiting for the crop to be fully produced, it would be my answer to that. That is what I am referring to.
Okay. We have another kind of similar down that same vein. So you suggested earlier that forward sales reduce price risk. What data source are you using to prove forward pricing is a better pricing program than live sales?
So I wouldn't say that it's better or worse. All I'm saying is from the sense of risk. If I sell 10 bushels an acre today for 20 bucks for 20 bucks a bushel, I can't get less than that $20 a bushel. That is locked in. So that 10%, it is no longer at risk of losing value. But as you go, if you're forward pricing incrementally, sure, that doesn't mean you get the best price. And I'm not saying that doing forward sales is a better choice or a better option. I'm just saying when it comes to managing the risk of price going up and down, the best way to take away that risk is to lock some in terms of not best as in the best option monetarily, but in terms of the most effective way to take away that price risk is to price it.
And I think that piggies back on making sure you understand what your cost of production is. So when you're looking at those forward contracts and you see prices, you know, if you're locking in at a profit, and yeah, maybe you could have got more in the cash market, but you know you're going to lock in some profit and perhaps be able to pay down debt or look at expansion or whatever you're allocating those profits for.
Right. That's a great point, Colleen, because yeah, everyone, maybe not everyone knows their cost of production or their break even number. But again, if my break even was 10 and I could sell it for 15, maybe I could make 16 or 17 or get 16 or 17, but am I willing to bet the entire crop that I'm going to get that price? And I know the answer to this, but how many of you, if you saw a huge spike in the commodity that you guys produce, would you sell all of your crop? Well, of course you wouldn't. You're going to say, well, it's going to keep going higher, right?
Alex,
So
we would never do that, Alex. I don't know what you're talking about.
Maybe not you, Lane.
No, of course.
And maybe
no,
not
absolutely.
anyone who's tuning in today, but there are those who do that, and more often than not, that can end up in people as the kind of method, the term we use is catching a falling knife. You say you want 15 bucks for your wheat. Well, that'd be great. But say it goes to 15, you don't sell any. 16, you don't sell any. And then it comes back down to 15, you don't sell any. And then you end up selling at 14. And I'm not saying you can do whatever you want. There's no better way, good way. And no one sells every bushel at the high, or maybe they do. But the idea is it isn't about being the best marketer on planet Earth. It's about being able to kind of manage that relationship between the price of your commodity and the ups and downs and your commitments or the amount you've produced and the amount you've committed. So the kind of discussion I was going with today is kind of doing a little bit of that trading back and forth, where if you're saying, man, I like this price, I'd hate to miss it. But what if it goes higher, or what if I don't produce all the crop I'm doing? Well, take a bite-sized chunk out of it if you're comfortable. And if you're not, then don't. These are just ways that I'm explaining to swap one risk for the other in either small, large, medium increments. So it was not my intention to say one was better, one was not better. In the most recent years, a lot of people have done better on the cash, and that's kind of just a fact. But back to the cost of production discussion, it's also about knowing your cash flow needs, right? So if you know every year you have payments due in February, well, typically, at least in Manitoba and Central Prairies, we go east with a lot of our grain. So a lot of the time, the prices aren't very strong in February. So if I show up on February the 6th and say, I have a load of X to deliver, they're going to say, great, we'll take it, but you're not going to like the price. Right? So it's understanding, okay, well, if I know I'm going to deliver in February, let's keep an eye on that February price so I can maybe feel like I have a bit more control of what I receive versus just showing up when I need it. So that's kind of where my comments on forward selling is. It's a tool. I wouldn't say it's not gospel, right? It's a tool that is for you to use however you see fit, whatever you're comfortable with, but there definitely are different ways for you to kind of maximize your benefit.
So this next question is kind of a two-part, and so the first one, debt seemed to be from the polling seemed to be the biggest risk that people on the call today were concerned about. You guys both work with a lot of different clients. Does that match up with your experiences working with your customers one-on-one? Generally, the debt is one of the biggest, and I know it's going to vary, but just curious generally, and then there's a follow-up to that.
Did you say debt or death?
Debt, sorry.
Debt. Okay, I would say it's hard to say because there's a few buckets of types of producers. There's those who have a lot of debt and who are in trouble. There are those who have a lot of debt and who are really good at what they're doing, and they're just really aggressive. We we have some clients who are highly leveraged, but that's kind of their strategy is to leverage, grow. Maybe they're a bit higher risk in terms of if there's a downturn in the market, they might not be able, maybe, right? Then there's those with low debt and low risk tolerance who sit there on their nest egg and say, well, I've got, no debt. I've got, a nice nest egg with my land and my home quarter here, but I refuse to take any risk. Well, that operation might not grow because they're not going to have 3 million. They might not have $3 million of cash lying around to buy out the neighbor. And they don't have to either. But if they were willing to take some debt risk and say, well, maybe I can put half of it down, the bank can help me with the other half, I can pay off, over 15, 20 years. It's about, again, it's a slider, right? It's not saying I refuse to have debt or I have all the debt. There's a mix that's good for everyone and their style, not just their comfort level.
I would also say, I think our producers are often more comfortable with production and price risk because it is a little bit more tied to, the state of actual farming, where debt risk seems to be a little bit more removed from the day to day. And so that one can at times perhaps sneak up on us or require us to step back and have a little bit more high level. So that might also be why people are a little bit more uncomfortable with it. Your production you're faced with every day, especially during, if you think of a crop season all summer, you're looking at how those crops are going or how your animals are growing. And so it's a little bit more difficult to ignore.
So thank you both for that. So the follow-up to that is, do you have a recommendation for a good debt ratio?
Killian, did you have something there?
Yeah, it depends.
Okay.
I think part of it is going to depend on a few factors. So we will get into this on our financial session, another one of the webinars. But, if you're a new farmer or if you're an established farm, you may have different thresholds of what a really strong ratio looks like. Or if you're in a supply managed industry with more consistent cash flow, as opposed to maybe a crop production where you have one production cycle a year, those ratios need to look quite different. And they need to be supplied in a different level with the bank. So there's going to be some indications, and it's going to be pretty personal on where you're sitting, as well as kind of what industry specific you're in.
Colleen, I love the plug for the upcoming webinar. Fantastic. We're just over our time, and I'm going to end on this last question to you both. Do you have some guidelines on estimating yield when it comes to calculating your cost of production? We talked about the cost of production piece. Is there kind of that yield that is a good estimate, or maybe it varies by farm based on what sort of yields?
I would say a lot of the time we challenge our producers to be conservative, and that's what anyone would tell you. But at the same time, you need to plan realistically, because the amount of times I've seen people who are saying, oh, I'm going to have a 50 bushel wheat crop and end up with 75, and then their whole marketing plan the whole way through the year was actually wildly incorrect because they were trying to be too conservative. So they said, oh, I'm comfortable with 10%, but 10% was only 7%. They maybe missed out on some opportunities. So honestly, I would say you as a producer, you know best for your operation. There's the hopefuls, right? There's the conservative type who are willing to say, I'm going to have a 70 bushel wheat crop. But you know best, you know your operation best. the amount of people I've interacted with that says, oh, that one will do 10 times better than this one, but then if this rotation now is on that field, some of you are so well versed in your own operation that I can challenge you and say, hey, that seems a little low, or oh, that seems a little high. But at the end of the day, it comes back to your comfort zone of, if you're happy to put on paper and to plan your whole year, your whole strategy around a high yielding crop, you have to live with the consequences that if you plan for that, you spend, you sell, you spend, you sell at that, with those expectations, you have to have that comfort that if you're incorrect, what does that look like? And I would say, yeah, I would say try to be as honest with yourself as possible, but that doesn't mean conservative or aggressive. That just means what you honestly think it looks like or could be.
Yeah.
Colleen?
And oftentimes history is a great indication of that as well. And then that's probably where a lot of those gut feels come from when you're looking at it, but kind of see what you've done in the past and take into account what factors you think might change this year. There's going to be some weather differences annually, but what you've been able to do, especially with that land, you can probably give a pretty good guess, and feel free to throw in maybe a little bit more, a little bit less, and see what the differences make. And the only other thing I would say is when you are looking at that, don't be afraid to update it. If you're getting through the year and you think, oh man, we're having a bang up year and I want to see what it looks like now with a really great production, go ahead, update that, see where you're sitting. And if you have any unlocked in prices or analysis that you can do going forward, now you have a new benchmark to work from.
Absolutely. And that can be even a great increasing that yield. If, like you said, you're having a great year, if you're deciding on fungicide, for example, it can give you a more realistic picture to say, does it make sense to do this based on where we think the crop is actually going to end up?
Absolutely.
With that, I always am feverishly writing down notes of takeaways that I had, and I'm going to give just this one, and that was all around kind of that big picture thinking and the what if scenarios. I love how you talked about that, Alex, in terms of thinking about, if this happens, what does that mean? Like a death in the family or death in the business, what does that mean? And so really encourage everyone to think about those things as they hopefully rewatch this. And what are those takeaways as they think about their business? I'm also going to make a plug to Colleen and Alex for one of our upcoming sessions. Someone did ask us to speak about hedging tools. So, maybe we talk about a little bit about that when we get into our financial session later on. But just keep that in the back of your minds that curious people want to know about kind of where to go for those tools. So we'll tackle maybe a piece of that in an upcoming session. With that, that takes us to our hour and almost 10 minutes. We thank all of you so much for taking the time to be with us. Thank you, Alex. Thank you, Colleen. We will be back here again at our next session on February the 27th. If you have not registered for these, please do so. You will also get an evaluation form. Fill that out. Let us know what you want to see if there's anything you'd like to see us adjust for the last 3 sessions in this series. And with that, take care. This recording will be sent out to you with that evaluation request in the upcoming days. Thank you for your time. Be safe out there and have a great day.